Your next guest sees the market turmoil exacerbated, of course, by 1980s type rate hikes. Tony Dwyer is Canaccord Genuity's chief market strategist. And I guess, Tony, welcome. Today, the big question for our audience, maybe the only question, at least right now, is, was today the big flush, kind of the big capitulation? And I know we won't know until later, but I want to go through this list and get your take. According to Jones Trading, they have kind of like the aspects of what they see as a washout trade, and there are some there. Okay, so volume more than 20 to 1 on the downside of the NYSE. Even recent winners like energy stocks getting hit hard. In other words, breadth was horrendous for much of the day. All 100 NASDAQ stocks were down. Only one, by the way, closing higher. Investor fear surging. To Pete's point, the VIX up 25%, although not taking out its February highs. So, in other words, Tony, some signs of that big capitulation, some getting there, some not yet. Was today the bottom? Was today a bottom?
And that really is the question. I think to follow up on what Dan said, I think you get signs that you're at a bottom. And over the course of the last few months, and we've talked about it on the show, what differentiates a bottom versus the bottom. So let me answer the question first. Today, according to our data, was the third consecutive day where 85% of the volume on the NYSE was to the downside. That happened since 2009. That happened on the initial low in 2015. You had a vicious rally. You retested the low. You went almost all the way back up to the all-time high, and then you cratered at the end of the year. Also in 2020, after the turn from the pandemic, I think it was June of 2020, you again had a kind of a vicious counter trend rally after that, and you retested the low. So I think, Brian, the discussion really surrounds the most frequent question I get is, typically I've been bullish over the years, but there's a money availability problem that we've talked about on the show for the last few times I've been on. And money availability is what defines the bottom. When you put all this great academic studies and the stuff we talk about and come up with great formulas and sayings, ultimately you have to have money to buy stuff, to do stuff, and to invest in stuff. And the avenues for money availability have largely closed down since the beginning of the year.
Yeah, and to that point, let's talk about the Fed, Tony, because I know that it's kind of the score. We get obsessed a bit with what they're going to do with rates. But the Federal Reserve is a lot more than just interest rates. It is about buying bonds. It is about selling bonds. It is about providing liquidity. It's about the comments that they make. I know we get all caught up in the headline number. Is there anything outside of a rate hike, which we know we're going to get, that the Fed can say or do that would change things? Because I think you have said this. I know many people on this desk have said this for months and maybe longer. You're not going to get probably a market bottom until the Fed turns.
Well, the Fed's got to signal a turn. In 1994, they raised rates even into early 95, but the market had already turned because they had signaled the end. That's the opposite day here. The real issue here is, I think it was Tim or Dan mentioned going back to the Volcker era. And when you had Volcker, it's really important. Debt to GDP in the Volcker era was at a generational low. It had come down from the post-World War II buildup in debt. So debt to GDP wasn't anywhere near the issue it is today. We're at a generational high at 138% of debt to GDP. So if you're going to take a levered economy and shut it down, that's not good. Target is the example. So in summary, what we've done here is we've taken limited money availability, bloated inventories because of the supply chain constraints, cratered CEO and consumer confidence into a lower demand environment in a levered system. So when you add up, I sound like, this is what we talked about, I think, at the end of April when I was on, and Grasso said he never heard me sound so negative, because it's all about money availability. Upside in the market, or upside in the economy, or upside in anything has to come with more money.
Tony, looks like you're running out of time there, and I don't mean that. There's something just popped up on your screen that said that. You talked about Volcker.
It kind of signified the market, to be honest with you. I mean, that's exactly where we seem to be. And by the way, have you seen Zoom stock? It's because a lot of people are downgrading off the premium plan.
Well,
be clear.
We don't want Bark, so I'm one for two.
We don't want to lose you too soon, Tony. I want to ask you about some of the positive things from market. All we've done is talk negative.
For sure.
Positioning is awful. If you look at the professional community, positioning is also very, very conservative. In other words, there's a lot of exposure that's been taken off the table. You've got corporate buybacks almost at a record pace. I mean, at some point, these are factors that say the market actually has priced in a lot of pain. We've priced in probably 90% recession at this point.
Timmy, I got to say, so let's put the numbers to it. The data that I have is when core inflation is above 4%, market trades at 13 times earnings. When core PCE is between 3 and 4%, it's 16 times. When core PCE is between 1 and 3, it's 20. 19.5 to 20. So we're around that. I would expect that it's going to peak and come down by year end. So you'll be in that 3 to 4% area. So you can do a 16 multiple. And, ultimately it comes down to the E side. I've been below the street all year. I love the game that we're in where we raise targets and estimates as it's going up and then do the reverse when it's coming down. I've been at 225 since last year. I don't see any reason to really change it. The street's at 229. It still has to come down, Timmy. To me, I think when you look at some of the data that's coming out, in housing. And we hear a lot of times that we're going to avoid recession because the consumer balance sheet, household balance sheet, and the corporate balance sheet are in great shape. Somebody better tell the University of Michigan Consumer Sentiment Survey, which has never been in its history worse, or the CEO Confidence Survey coming from the Conference Board. So a recession seems increasingly likely, and the numbers still have yet to reflect that.
I think it's a good point, Tony, and these are all incredibly important points that you have been making. Tony Dwyer of Canaccord Genuity, and maybe just get out of the way of this moving train that is a market for now. Tony, we'll see you soon.
Really, Brian, I'm sorry to interrupt, but it's really important that, A bottom versus the bottom. You've had 83 days in a row of 85% downside.
Well said. We'll see and we never know until we look back in history. Tony Dwyer, thank you very much. Pete, can you help square that? Because I think what Tony and everybody's making is a really important point for our audience. I was down your neck of the woods this weekend in Sarasota. Flights were packed, airports packed, hotels packed, restaurants packed. And yet we're talking about economy slowing down. We're talking about consumers going out. But what you see with your own eyes and what these numbers are saying, they do not link up at all.
No, you're exactly right. They certainly don't. But I think, Brian, the real case is, are these people that are going on their one opportunity to go travel, matter of fact, to go to Florida or whatever it is, are they going to be able to do that again? Probably not. We all know how expensive gasoline is as far as driving around as well. People are willing to make that trip, but those are sacrifices that takes money away from other parts. So, yes, that looks really great when we see as busy as they are, but there are other elements that go into it. They can't spend over here because they've already spent over there.
Yeah, I'll just mention this. So Tony made a great point about a bottom versus the bottom. Think about the March Fed meeting. It was very well telegraphed. They were going to raise by 25 basis points. It was going to be the first raise in a long time. The stock market had sold off from its highs in January. It was already very volatile, down about 13% on the day before that Fed meeting. Rally. Huge rally into the end of that month. It was also the end of the quarter. Might not be too different than what we could see right now because, again, if they
But that would be a rally in a bear market.
Sounds like Dan's a buyer.
Well, no, what I'm saying is like, listen, you guys know me. I hate most markets. I don't press lows like this. That's just no way to make any good money. So if you're trading, and Pete knows this as it comes to options, if you're making a defined risk bet using puts or put spreads or something, you're buying when vol's here, where the VIX is where it is, and you get the opposite move, you get creamed. And the same thing going for shorting stocks in this environment. So it's just not a great price.
And that's an important point. So I know we got to go to break, but just very quickly, Dan, to button that up, what you're saying to the audience, I think, is don't get super defensive here either, because we could have a bear market rally, which then if you're overly short, you're overly negative, it's going to rip your face off on the other direction.
This thing's going to take time to bottom out. You're going to have opportunities to trim things on balances. Don't trim things on days like today.